Okay, welcome everybody. Okay, so today I'm going to talk about some of the proper uses for technical indicators, and I'll be honest with you, I tend not to use a lot of them. Yeah, actually we can hear it a little bit better today. Obviously I decided to change computers from my last webinar. This will hopefully be much better. Unfortunately I don't have the webcam this time, so you don't get to see me smiling at you. But we're going to take a look at the technical indicators and proper ways of using some of these indicators. And it's interesting because if you look at my name, I'm a chartered market technician, which means that I've done a lot of study on technical analysis. As a matter of fact, I had to study over probably about 745 technical indicators and how they're used. The thing is that when I'm trading, I use almost none of them. I've got plenty of experience in seeing what works in the markets, and as my peer Sam Seiden shows you guys in a lot of his webinars, it really comes down to looking at price. What's focusing on what price is telling us. Are we looking at an uptrend? Should we be looking to buy? Are we looking at a downtrend? Should we be looking to sell? And we buy and sell at areas of demand and supply. So for instance, if I'm looking at the euro dollar, which I happen to have up in front of me at this point, I can see that, hopefully you can see my screen as well. I'm sharing my desktop here. And you can see that on the daily chart we were in a bit of a downtrend, kind of bounced a little, kind of back and forth, so to speak, at this point where we're stuck in a little bit of a range. But I would really prefer to trade something on in a strong trend. So if I'm looking at trading the euro dollar on the daily chart, I don't really have much of a trend because right now I'm having similar lows and kind of stuck, not necessarily making lower highs and lower lows. Right? The definition of a downtrend would be lower lows and lower highs. Well, we've got the lower highs right here and right here, but we're failing to make the lower lows yet. So we don't really have a defined strong trend here versus something like the dollar yen. When I switch over to the dollar yen, we can obviously see a trend, right? What is our trend in the dollar yen right now? Well, it goes without saying it's obviously very, very bullish, because we're making higher lows and higher highs. And that's going to be one of the issues that we have when it comes to some of the technical indicators. For instance, if I were just throw in, let's see, we'll do a stochastic here. And I'll go to a slow stochastic. It doesn't matter what time frame you're trading on, excuse me, everything works about the same, or doesn't work, I should say, about the same. Let me thicken up the lines here for a moment. There they are. So when we're looking at these stochastics, if you're trying to use the stochastics as a buy or sell signal, generally most of these indicators are going to be giving you sell signals and buy signals late. And I'm working in London right now. I'm in the middle of a class here, and we were just talking about these indicators and how if we take a look at some of these signals, if I'm looking to buy at strong demand zones or sell at supply zones and join the overall trend, by relying on these indicators, I'm going to be getting in very, very late. And that's going to increase the amount of risk I have in my trades and decrease my potential for profits. And that's obviously opposite of what we want. So looking at this area, we can see that there was a basing and the start of a move to the upside. This is not the strongest of demand zones, but as we came back down to that area of demand, you can see we tested that and took off very well, because what we were looking to do was join the overall bullish trend. All I'm doing is basically figuring out which direction the train is moving, and I get on board at the station. Now, I wouldn't want to buy in the middle of the trend, because if I buy somewhere up here, that'd be like jumping on a train as it's already moving. I have a lot of danger, and usually I'm going to fall off, because right here, if I bought after we'd moved up, you can see it crashed back down below my entry and would have stopped me out or caused me to panic for a loss. So I definitely wanted to get in at the smartest areas, which is getting in at a demand zone on a pullback right there. Well, looking at the indicator, if you take a look at the technical indicator, the stochastics, it appears that the crossover has already occurred at that low point. But in reality, those two lines, if I zoom in a little bit more, you're going to see that those two lines don't actually cross over until we have already passed the optimal entry point. Let me just fix this horizontal line here. Style, there we go. Make it a little bit darker. So you can see that the crossover doesn't actually occur until after we've already left the area, because you wouldn't have seen this crossover happening on this red candle. It would not have happened until this green candle was forming. Well, by the time that green candle forms, now we're getting in very, very late in the trend. It doesn't seem so critical here, but it does seem a little bit more critical when you put in real pricing there and realize that you could have gotten in. Let's see what this price is. Sorry, I have to move the chats off of the side of my screen. Hopefully you guys don't see those, but instead of getting in at the demand zone, which is 92.56, we probably would have been able to get in at about 92.14. So we're giving up about 60 pips in that case, and that's way too much to be giving up on individual trades, especially if you do that on a habitual percent. Every time you're trading, you're always entering late. Not to mention, if we're in an uptrend, I don't really need to get out if we're overbought. And that's where the indicators go above certain lines. If you want to learn how to use some of the technical indicators that are out there, you can read almost any trading book. But to learn how to do them properly, how to use them the right way, you actually need to follow what we teach at Online Trading Academy, which is really just using them as a kind of an odds enhancer, so to speak, to help you identify at your supplier demand zones what are the highest probabilities for your moves. Okay. So once again, you can see we pulled back right into a nice little demand zone here. Let me put that in again. Yeah, we use them for confirmation, exactly. We don't use them for decision making, but we can use them for confirmation. Okay. And even here, we had this rally and then drop back down into a prior demand zone, drop base rally. Wasn't the strongest of levels, but it did work. And you can see that if we were waiting for that crossover, the blue line crossing above the red for a buy signal, it didn't occur here. It did not occur here. It did not occur until the middle of this green candle. Okay. See, right now we can see that the price of the yen, or the dollar I should say, is selling off against the yen. However, if you were using traditional technical analysis, one, you may have gotten a sell signal right there where the blue crossed below the red. That would have told you to exit your long, which is okay. However, if you're waiting for a cross below 80, which is a traditional technical analysis entry for a short, you're not going to get that signal until after this red candle is finished forming. If this were a supply zone, you're giving up a lot of price. You could have possibly entered a short near 103. Okay, now you're looking at 1.5, 101.5. So you're giving up a lot of pips by waiting for the traditional technical analysis signals. So that's why I wanted to show you there. It gets even worse. If you go into a smaller time frame, you can kind of see what happens where the prices are not moving or not confirming. Notice when my price moves on this 2-minute chart, you see those indicators jumping a little bit. That's why you always have to wait for the closing price, because all these indicators are based on closing prices. Okay, so until that candle finishes, you might say, oh wow, we've got a nice little double top formation here, I better short, right? Well, first of all, you're waiting for confirmation of a breakdown of a pattern, which is always late. And secondly, you're never going to get a sell signal here coming in on the breakdown anyway, because it's already given you any kind of signals way, way back here. But once again, they would have been at least one candle late from the highs. Okay? So take this back out to my daily chart. And I'm going to get rid of the stochastic there for a moment. Basically, what I'm going to do is bring up a couple slides and just kind of show you when we are using oscillators, any kind of oscillator. One thing everybody always asks me, what's the best oscillator? What's the best indicator I should use? And most people look at me like I didn't answer the question, but I tell them the best indicator is always price. You want to see what is your trend, where are your supply and demand zones, and therefore figure out the best opportunity for you to enter into the trade. No indicator works every single time. Sometimes you're going to have some failing. Sometimes you'll get some false signals. One of the things you'll notice when you go to your indicators, I'll go back over here to my trade station and bring up another indicator. We'll just bring up the CCI, Commodity Channel Index. There we go. And let's see, go ahead and darken that a little bit, thicken it up. There it is. So whenever we're looking at this indicator, one of the things I can do when I'm going into my inputs, right now this is defaulting to 14 periods. In order to get more timely signals and reduce the lag, we're often tempted to change the length of our study. So maybe I change it down to 8 periods. Notice the lines jump a little bit steeper. So it will give me faster signals, but at the same time I'm also going to be receiving more false signals. So if I had taken a signal for a sell, for instance right here, you can see we just retreated a little bit, but we went from positive 100 and crawled back below, and traditional technical analysis says this is a sell signal. Well, would you have felt a little bit foolish if you had sold here, only to see prices continue to rise? I know I would have. So the main thing is that we have to trust price. We buy at demand and sell at supply zones. Okay. Now, we're looking at the indicators. There are some uses that we can get out of these indicators. Go back over here and basically say that, indicators work in all different time frames. I was just demonstrating on a daily chart, but the same type of analysis I do on daily charts will also work on intraday charts and even weekly charts. It doesn't matter. Time is irrelevant. What matters is being able to read price and use the indicators to support your decisions based on that supply or that demand. There is no one indicator that works all the time, therefore it is more of an art. You kind of have to be a bit creative when looking at price. What we're doing is trying to imagine where prices can go in the future. And price is a lot like water. If you take a glass of water and pour it into your hand, water usually takes the shape of whatever vessel's containing it. And if you put it into something like your hand and tilt your hand, water's going to flow downward because of gravity. It's going to be pulled downward and flow away from your hand. The same thing happens with price. It's typically going to try to move in the direction where it has the least amount of resistance. Okay. More validity over time. What it means is that technical indicators were originally developed, most of them in the 1970s. And because they were developed in the 1970s, this is way before we had a lot of computers that we can use today. So people were hand drawing charts, and they were using daily charts for the most part, the closing prices of each day when they developed a lot of these indicators. Not to mention when you're looking at trading as a whole, more people are looking at longer term time frames such as daily or weekly charts than they are looking at every 5 minutes or every 15 minutes or even 4 hours. So the validity is a little bit stronger because when you're using longer time frame charts, it's kind of showing you more investor sentiment or trader sentiment over time rather than trying to look at just a small time frame. That's all it is. Okay? And by the way, feel free to ask questions. As many questions as you guys want, I'll try to answer them. If I don't know the answer, I usually make it up, and you guys don't know the difference until after I'm already gone. So it works. I'm just kidding. No, I won't make up an answer, but I'll figure it out for you. Anyway, the other thing you got to be careful of is that you don't put too many indicators on your chart. If you put too many indicators on your chart, you can't read price because it's so clouded up with everything else. Right? We want to make sure that's reassuring. Thanks, Ray. Yeah, we want to make sure that we can read price. So the way we use indicators in Online Trading Academy, we actually teach both how to find supply and how to find demand, as well as how to identify the stage of trend that you're operating in. In stage 1 or stage 3, those are usually sideways consolidation. We buy the lows and sell the highs. And we wait for a breakout of that range and then start a new trend. So in that case, the indicators may be useful to give us overbought indications when we're at demand zones or oversold indications at supply zones. So we can use them as a confirmation at supply and demand. However, in an uptrend, we're going to be looking to enter into the trend when we have retracements back to a demand zone. That's the key thing we're going to focus on, is a pullback to a demand zone. And as far as the overage, so to speak, the indicator should be reading oversold. Okay. Gabriel, I absolutely believe that the more recent supply and demand zones are going to be much more valid than old ones. Because think about what you had for lunch yesterday. Now think about what you had for lunch 3 weeks ago last Tuesday. It's obviously much easier to think about what you had yesterday, isn't it? And if you can see it on your chart without having to scroll back very far, the fact is that it's probably more recent in time and therefore more valid as well. But it doesn't necessarily mean that the levels that are way back, going back several days, weeks, or even years, okay, it doesn't mean that they're not valid. Okay, we do what are called odds enhancers, and we teach those in our classes to be able to help you find the best supply or best demand zones to be able to trade. Okay. Yes, bigger time frames are more important and they're more powerful, but it doesn't mean that if I'm trading on a 5-minute chart, I can't use supply and demand on 5-minute charts. It just means that I have to be aware that the larger time frames are going to be more potent. And actually, if you go back to one of my old recordings, I believe And here at FX Street, I did a recording on multiple time frame analysis. Not sure if it was the last one I did or a couple times ago, last month. But I do follow multiple time frame analysis to figure out the highest probability. As far as more art than science, all it means is you're going to have to be creative. With technical analysis, it doesn't always work. So that's why we have stops to protect ourselves in case if a trade doesn't work out the way we anticipated it to. So it's more of an art, meaning that 1 plus 1 sometimes equals 4 rather than 2. So we have to be prepared for some of the alternatives that may happen in price. Well, continuing on, in a downtrend, what we're going to be looking for is a rally up to a supply zone. And that's going to allow us, that's the train station once again, to be able to join the southbound train in this case. So we're going to be looking for overbought conditions in our indicators if we use them that way. We'll also look for something very important called divergence. Now, this is probably one of the best ways to use any technical indicator. Because if you find a divergence, that divergence usually occurs while price is either at demand or while price is at supply. So in this case, a positive divergence is what we're going to be looking for while we are in a bullish trend. However, we are pulling back to an area of demand. What we're seeing is that the prices are making lower lows. So they're pulling back into a demand zone currently. But we see that the indicator is failing to make new lows. It's either making the same or sometimes even higher lows. So we can even have price making the same low, just coming right back into a demand zone, but the indicator is making a higher low. When we see that happening, that's confirmation if we notice that at a demand zone in an overall uptrend. See, what I'm doing here with my trading is I'm having if this and this and this happen, I take this action. I want to make all of my trading rule-based rather than trying to allow it to emotion. Emotions are killer. And when it comes to trading, it doesn't matter what you're trading. So I want to make sure that when I'm trading, I have rule-based strategies. If this happens and this happens and this happens, I take this action. And if it works out, I get out at this area based on these conditions. If it doesn't work out, I have stops to protect myself. So a positive divergence is one that you would look for in an uptrend overall, and when you pull back to an area of demand in that uptrend, so you can enter into the trade with a little more confidence. So if we go out to our platform here, go out and take a look at an indicator once more, we can look for a positive divergence in an area of demand if we happen to have one. There's no guarantees I'm going to be able to find one right off the bat. Let's see, this is on the CCI that I'm still using. And let's see if there's a demand zone here. Well, actually, this is an area of demand. Once again, we're still on the dollar-yen on a daily chart, but we have an area that we've seen strong bullish pressure. Okay. Indicators lag, however, they're okay for divergence because the divergence doesn't lag. The buy and sell signals lag. Okay, but the divergence generally doesn't. Notice here we are making a low in price. We come back up, make a very similar low, but notice the indicator is diverging dramatically. It's making much higher lows compared to what price is doing. So that's a positive divergence. It's not the best example, but it is one that we could see that if we were looking to buy this area of demand and overall we were in an uptrend, that would be our confirmation I'd be looking for the trend. Okay. Going in a little bit further back, I was trying to see if there was another divergence here whatsoever, or a demand zone actually I should say. There we go. Yeah, we can see that the reason why we turned where we did, let's see, it actually broke that area and didn't quite reach this area of demand. Just trying to see if this was a demand zone too, because there was a little bit of divergence there as well, where prices had made lower lows, but it didn't do so on the indicator. Let's try a smaller time frame. Here's a good example of divergence. Let's see if we've got a demand zone there. Remember, I wouldn't take any trades unless I hit a demand zone. But if this were a demand zone where we were hitting these lows right here, and I don't see demand there, but if we were hitting these lows and finding demand at that point, if we're in an overall uptrend, take a look at what price is doing, making low and lower low, but the price is making lower lows. The indicator is making higher lows. Okay. How do you record this? You don't. The FX Street actually does record this webinar for you, so that way you'll be able to see it within about a day or two. I think later today, as a matter of fact, it should be available on their website as a recording. So anyway, you can see right there, lower lows in price, higher low in the indicator. That's positive divergence. The downward momentum stopped and told us that we were likely to see some bullish pressure very soon. Okay? No problem, Mohammed. So the same thing could be seen if we're looking for a shorting opportunity or an exit from a long. This would be for a buying opportunity. Okay? So if we go to negative divergence, that's where we're moving into areas of supply, making similar or higher highs. However, the indicator is not making the same highs. That's what we call a negative divergence, and if we happen to see negative divergence when we are near areas of supply, that's going to give us a high probability that the markets are going to turn down. And therefore, we can look for a shorting opportunity, or, as I mentioned, we could also use this potentially for an exit out of a long. But I tend to usually use the indicator as confirmation for an entry, not so much as a confirmation for an exit. Okay? So, oops, sorry, I should have left that there. This is an example of divergence. You can see similar highs in price, but we have bearish divergence because we have lower highs in the indicator and prices turned down sharply. Looking back here, we have an area of demand, nice little rally off this drop and base. As we came back into that demand zone, we were given a signal because this is an overall uptrend. We should have been looking for where to go long and join the overall trend. And in this case, there's the low, the demand zone. Here's our retest. Price is making a low and lower low, but we have a huge bullish divergence. That was giving me the extra confidence I needed to buy on that gap down. Now think about it. How many people are really willing to buy after a major gap down like that, especially in Forex? If that happens from Friday to Sunday, you're not feeling very confident of buying something that's dropped down dramatically. But as a professional trader, you have to be willing to do so. And this makes you feel a little bit more confident because you have that indication that there's a positive divergence, or what they call bullish divergence there. So going into my indicators, as far as the defaults, I think the default setting here is 14. I actually don't use CCI. Okay, I used to for a certain period of time. I actually changed my indicator from the default, which was 14. I changed it to 13. No real reason why, other than I like Fibonacci numbers from time to time. But as you saw, I had it sped up to 8 a little bit. I use the divergence on whatever time frame I'm trading on. So whatever I'm trading on, for me, I trade on 5-minute charts, even on Forex. And for instance, if you go out to a daily chart here as well, I think I saw divergence. Yep. Notice what's happening on the daily chart currently of the dollar-yen. This big candle that we're having to the downside right now was predictable because you can see negative divergence. The indicator is moving lower while prices were trying to make new highs. It was showing a bit of weakness. Now, one of the things I want to show you, let's see, should have a browser here available. Oops, wrong button. And if I go into, let's see here, tradingacademy.com. I'm always scared going into somebody else's browser. I'm on somebody else's computer, so I never know what's going to show up. But if I go to tradingacademy.com, this is our website, Online Trading Academy, and I go to resources, you'll see there are lessons from the pros, and I'm sure some of you read these from the pros. Great articles out there on all different asset classes. Sam Evans and Rick Wright do a great job writing about Forex, so I highly recommend you read their articles. You read those every week? Great. Yeah, like I said, we've got everything covered for the most part. I do the stock articles, and also for India as well. But like I mentioned, if you want to see some good information on currency, right there, Currency Questions and Answers, Sam Evans and Rick Wright share some of the duties they're writing. Those are great articles there. But one of the things I wrote about, and I'll go back to the home page here, or actually, yeah, I have to go back to the home page. I'll go to a search, 6040. And I'll just do a search there because I wrote an article, March 8th, I believe it was, 2011. So it comes up here in just a second. There it is. Yep, March 8th, 2011, I wrote an article called Use the 60-40 Bounce or Break for Greater Profits. And I can use this, there's that handsome guy. Anyway, what I wrote about was the way I can use these indicators. Now, I can't take credit for this. I did not come up with this system myself, but I do use it in my trading. I actually read a book by a fellow market technician named Constance Brown. And in her book, she recommended using the the RSI this way, and I've kind of adapted it a little bit to my own purposes. So I'm going to show you that today. What typically happens in a strong trend, and we definitely have a strong trend here in the dollar-yen, don't we? We've been in a strong bullish uptrend. What will generally happen if I put in the RSI is we won't get signals. Okay, so if I go down to RSI, and I will leave it the way it is, 14 periods, 70-30, but I'm going to change the color, and I'm going to, thicken the line just a little bit. There we go. Notice the traditional RSI says that if you go above 70, you are overbought, and if you go below 30, you are oversold. Okay. However, in this bullish run that we've had on the daily chart of the dollar-yen, we haven't been below 30 since June of 2012. So if you had just used the buy signals from the RSI as an indicator, you never got a single daily buy signal, missed out on this entire bull run for the RSI. So that doesn't work too well, does it? Same thing happens if you have a strong bearish trend on a currency pair. It doesn't matter the time frame either. We can go into a smaller time frame. Perhaps I use a 30-minute chart here. And the same thing today, you can see that from 5 p.m. yesterday, New York time, we've been in a strong bearish trend. You are not going to get a single sell signal because we're not going to get above 70. As a matter of fact, in a strong bearish trend, RSI stays below 60. So if you're waiting for a signal at 70, you're just not going to get it. I'm going to go ahead and change the font here, make it a little bigger so we don't have to squint at the screen. There we go. So in a bearish trend, RSI stays below 60. It always does. However, in a bullish trend, let me go ahead and get the alphabet there again. The RSI in a bullish trend stays above 40. So really, all I have to pay attention to is to see if my trend is staying in that direction. Okay. So what we look for is, and I've got kind of a saying for this. Sorry, I'm laughing at somebody in the room here. When I'm looking at taking a trade, I actually use the RSI as a filter whether or not I should take the trade. Okay, I don't necessarily take it based on a signal on the RSI, but I do change my RSI inputs. Let me just do that first. First thing I always do is I change those inputs. For the length, I use Fibonacci number 13. Again, it speeds up the indicator a little bit, but not by much. Secondly, I use my oversold as 40 and my overbought as 60. Okay, and I'm going to go ahead and do that. There's my RSI now with the 40-60. So in a bearish trend, if the RSI, and I should spell things correctly. Anyway, I realize I put in an E where it doesn't belong there. I'm a perfectionist. I got to change that. It's bothering me. Stays below 60. There we go. All right. So if RSI is greater than 60 when I'm looking to go short in a downtrend, then supply is a lie. That's my little saying there. Well, if we're in a bullish trend, RSI should stay above 40. If RSI is below 40 on a bullish trend when I'm at demand, is less than 40, then demand will not stand. So I use this as a filter to keep me out of trades that may not be as high quality or could cost me money, could basically give me a loss. So when I'm looking at my trading opportunities, I'm going to go ahead and keep that 60-40 in mind as I'm looking at trades. So if I go back to the daily chart here on the yen, all I have to do is buy pullbacks to demand if I'm in an uptrend. As long as we're not below 40, okay, we have a high probability of making fresh highs. Now, sometimes it fails me. You can see right here, we pulled back into a demand zone. As a matter of fact, I wouldn't say it necessarily failed me. Let me just show you why. Okay, if I'm looking for pullbacks to demand to buy, okay, here's a pullback, and we're into an area that was a bit of demand. No, I actually want RSI to stay above 40. If it's approaching 40, I'll keep an eye on it, but if it goes below 40, I would probably get out of my trade. Let me just explain this. Here we are in an overall uptrend on the dollar-yen, right? I'm going to be looking for areas where bullish pressure started after a basing to be able to go long. We move forward here, and sure enough, right there, we hit that demand zone. I take a look at my RSI, and where is it at that point? It is sitting above 40. Therefore, I'm okay to take the trade, and the next move up should exceed the prior highs. Notice it moved up, exceeded the prior highs, no problem. But if we happen to come down to a demand zone, and right now I've got a little bit of demand right here, just kind of moving forward, maybe my next opportunity to go long. There we are, testing demand. Okay, are we below 40 on the RSI? No. Therefore, probability to buy is very high. We should be able to exceed the prior highs. Well, that one didn't work out. Okay, and the reason why it didn't work out is we went forward right here on this candle. So right there, or is it the next one? One of them, it went below 40. So as soon as it went below 40, it would have stopped me out. Plus, having it go below 40, it tells me that this was not the right opportunity to get in right away. Well, I missed out on a chance there. Remember, not every indicator is perfect. Okay. What is the word for the opposite of basing? It would be trending. So you're either basing or trending. Now let me go into a different time frame, maybe even a different security. Since I'm in Europe, I'll do the cable. And we can see that on the daily chart, we seem to be in a little bit of a downtrend right now. I know that the trend is breaking. By the way, this also helps me identify trend changes. You can see that in this overall move, we're making downward moves, lower highs, lower highs, lower highs, then all of a sudden, higher low and higher high. That breaks the downtrend, and notice the RSI is above 60. So that means our downtrend has to be over because we can't go above 60 if we're in a strong downtrend still. Same thing as we move forward, we're in an uptrend, making those, as I mentioned, higher lows right here and higher highs. 1, 2, 3 touches. When do I stop going long? Well, if I had gone long on the test of the demand zone or the trend line here, which I don't normally trade trend lines, but if I was expecting this demand zone to hold right here, we had some good buying pressure out of that area, right? We came down, based, and bullish move to the upside. The fact that on this candle coming into the demand, it's even before the green candle, I'll zoom in a little more so you can see it. Before we even had that green candle, here's my demand zone. Coming back to that demand, notice where my RSI is. It's under 40. That's telling me don't buy. First of all, you've broken the trend, and you are seeing weakness. What happened? You would have been stopped out, and not only that, now we started to become a bearish trend here. So it helps me identify which side of the trend I'm on, as well as telling me when that trend is over. But for the most part, when I'm using that RSI, I will now look for selling opportunities. In this case, on the pound, if we get a rally back up to some selling pressure. And for supply, I don't really have a great one here, but this is a bit of basing that we've had, sideways motion with red and green mixed candles that was resolved with some selling pressure. If we were to come back up, I'm not going to take this short because it's not a qualified supply zone, but if it were, I would not want to see the RSI going above 60. If the RSI stays below 60, then I would be okay with a short. If it does go above 60, I would not expect that trade to work out, and therefore I probably wouldn't take it. So if I go into a smaller time frame here, like a 30-minute chart, you can see that the RSI can help me out with identifying trend shifts. We were in that bearish trend for several days, and right here, as we broke to the upside, you just kind of pull this back, If I was looking to sell short at areas of supply, perhaps I was looking at this, oops, let me fix that. This area here, although it has kind of a wild wick, so I may not have wanted to take that anyway, but this area that had selling pressure, when we came up to that area, we were above 60 on the RSI. It's telling me don't try to short here. If you short, you are not going to be able to exceed these prior lows without a major correction. And sure enough, what happened with the price? It just went sideways now. However, in previous areas where we reached selling pressure, see if we have a good example of a strong supply zone somewhere. You know, this wasn't the best, but this area right here, which we have been basing for quite some time, you can see we had this area, sideways motion, somewhat bearish, and then picked up with a lot more selling pressure here. When we rallied into that area with that big peak on the price, we didn't go anywhere near 60. That told me we were going to be able to sell here and make profits as it continued to move down. So I can use this on any time frame. I'll go even into a 5-minute chart. As I mentioned, I like to trade 5-minute charts. Right now, RSI, since 3:30 this morning, is not going below 40. Therefore, I have no reason to take shorts. If I was looking at any shorting opportunities, such as the selling pressure that started right there, that trade is telling me don't go short because you're not going to have a lot of profit potential. We had a small move down, couldn't really go below the prior lows, and corrected back up. So let me just go back to the beginning of this chart, so that way we can kind of see, without knowing what's coming up, what we're looking at. Okay, overall, RSI is below 40. We're in a relatively bearish trend. Okay, we notice there's lower highs and lower lows. My focus should be on looking for shorting opportunities in this time frame. Do I find 5 minutes too noisy? No, I'm okay with it. We could go to a 30-minute chart. It really doesn't matter, or even a 4-hour chart, 60-minute, whatever you want. It all works the same way. Just fix, yeah, I'll just keep it there. So, if I'm watching this chart, I'm going forward here, and I'm looking for a rally into supply to sell. Okay, here we are moving up into an area that appears to be the origin of some selling pressure, though this one is not a high quality level. I'm not going to go into what the quality levels or non-quality levels are, but that is a little bit of a rally base and a little drop, but not really the best of opportunities. However, the RSI is telling me we're likely to make fresh lows. Oh, there we go, into the zone. As soon as we went into the zone, the RSI peaked above 60, so therefore it told me not to sell. So while that candle was forming, I would have been warned away from taking a short. I already said it wasn't a good opportunity anyway. I need to find one that actually is a good opportunity. Well, now we're getting bullish pressure, so my focus should change from bearish to bullish. So as we go forward, I'm going to go from current price and look back for the origin of strong moves to the upside to give me an opportunity to go long. And it's much easier when the charts are live, but I only have so much time with you guys today. So we've got a couple areas here that I'd be watching for. If we retreat back to that, I would go long. Only if the RSI stays above 40. Well, unfortunately, no opportunities yet. Just have to be patient. Let's kind of speed it up a little bit here, see if it ever comes back down to a good demand zone. Well, guess what? Now I'm no longer going to go long. Reason why? We've become a bit bearish here. So again, it filters out trades that probably will not work for me. Okay. And moving forward, just trying to see, I don't have a really good opportunity. Maybe I should go to a larger time frame here. I'll go to a 30-minute chart and do the same thing. We'll go to another pair. I'll do Aussie dollar. Okay, so on a 30-minute chart, let's see how far back we need to go here. 40 days is more than enough. There we go. And once again, sorry, that's at the end. Let's go to the beginning so I can start off going to candle by candle and see, oh, I've got a nice area right here. That could work. If we pull back to that area, we had a rally base and had some good bullish pressure out of that area. But as you can see, it's getting foiled already because we've gone below 40 on the RSI, so I probably should not take a trade there. Kind of sideways motion altogether, building up bullish momentum. again. So on pullbacks now, two areas of potential demand. Looks like we might be having one right here. And obviously I'm missing out on a few other things. I'm not looking at the big picture that I normally would, but as we're pulling back into this area where we saw bullish pressure before, this RSI is telling me that we do seem to have a decent opportunity to have a rally. I was wrong again. This thing is just choppy all over this. Now moving in a downward motion, bearish trend. It's kind of hard with only one chart. Like I said, I usually trade with at least 3 different time frames. Looking for the selling opportunities now. Let's see if we can get a nice rally. Nope. Again, it started flip-flopping already to above 60. So depending on what trend I'm in, I'm going to be looking to trade in the direction of that dominant trend and just use the RSI as a filter. As you can see, we did that one pop above 60, but since then, bearish, bearish, bearish. So if I find a good opportunity, then I would look for a short. Let's see. Nothing yet. Boy, this is really tough. Here we go. Nope. I was just seeing that right here is our gap. We came up to fill the gap, but because we went above 60 on the RSI when we did that, we're not likely to take out these prior lows without some sort of major correction. See? That's me away from shorting that. And that's one of the reasons why I use this. I wouldn't even short where we are right now, even though there's lots of selling pressure right here, because you can see the RSI is too high. I'm just using different time frames. When I'm trading, I generally trade on a 5-minute chart with a 30-minute chart as my broader perspective. Okay, and let's pull this back here. Sorry. The reason why I wouldn't short, as I mentioned, we're not going to take out these lows without some sort of a correction first. And secondly, if you notice, overall trend has started to shift here. Here we have a low, and we have there's a low, higher low, and higher highs. RSI, we pulled back to this area of demand. Are we below 40? No. Therefore, we have a high probability of making new highs. There we go. And continued to make new highs. Notice we had another pullback to this area of basing. And with bullish pressure, there's our pullback. RSI stayed above 40, told us it's okay to take that long trade. Finally back into that prior area of supply, but because we're above 60, I would not short this. And sure enough, because I saw that it was above 60, I would have been stopped out very likely for a trade. Secondly, it's going to keep going up. So it prevents me from losing money. That's one of the key things. I want to make sure that I stay on the right side of the trade, protect my capital, so therefore I can start growing my capital. Okay? Any questions on what I was talking about there? Would I just take the long based on bullish engulfing? You're talking about on this candle right here? I don't take trades based on bullish or bearish engulfing candles unless they're in a supply or demand zone. So the settings I use for the RSI, I use 13 periods, oversold 40, overbought 60. So I think you guys can see the pop-up menu there for the RSI. Should show you that right there. Okay. At 3 o'clock. 1500 or 3 a.m. You're talking about engulfing. There's nothing here at 1500 for an engulfing as far as a long. Bullish engulfing. Yeah, are you talking about this here? 104, 200. Oh, the reason why I might go long there. Okay, I see what you mean. 3 a.m. the previous day. Okay. The only reason why I would go long is not just because of the bullish engulfing, but the reason why I could have gone long is actually before that candle happened. Remember, if you're using candle formations to signal a long, and you're looking for an engulfing candle, right there, that's actually not even an engulfing candle. The technical definition of an engulfing candle, you've got to have the body engulfing the small candle. That one actually gapped up just slightly, so it wasn't the same price. It wasn't technically engulfing. Secondly, if you're waiting for the engulfing pattern, you're not getting in until you engulf the previous candle at 104.237. Okay? Or even until you break a new high after the engulfing pattern. What I'm suggesting is I go long because I see this was a basing that led to bullish pressure. We retested this area of bullish pressure, and I'm able to go long at 148, 0414. Meanwhile, you're not getting it until about 0423. So I love that people get in late over here because that helps my trade out because I'm already in much earlier. What I'm doing is I'm buying at this area of demand on the pullback with the RSI filtering and saying, guess what? You're above 40. You should be able to take that trade. So no, I don't wait for the candle formations. The only thing I do is if I'm in a demand or supply zone, perhaps I might look at a little bit of the candle formation to help me, but for the most part, no, I'm just simply relying on those price action areas. Okay? How do I identify the areas of demand and supply? Well, that's the big secret. That's what we teach at Online Trading Academy. So I more than welcome you to come to one of our classes or take one of our online classes to find out. Hidden divergence, I'm going to have to say that for another session, unfortunately. Maybe I can do that for my next webinar. I've got to get back to my class. Unfortunately, we've kind of run out of time here. We only have about 45 minutes for this webinar. We've run over a little, so I'm going to have to bid you good afternoon. Do I teach options in the classes? Yes, we do. We have different courses, options, stock, futures, forex, and just trading in general, even investing. So you can take a look at our website, tradingacademy.com, and find out more information there. So until next time, I'm sure I'll be back again next month. Trade safe and trade well, everybody. I'll see you again soon.